And good morning, everyone, and welcome to another edition of Money Matters right here on WINN FM. Money Matters is a literacy public awareness program with financial coach and consultant Mr. Tarlie Francis. And it comes to you every Wednesday morning at 10:15 a.m. And we've been tackling some tougher topics that most of us tend to shy away from, just trying to save a little money. And so Mr. Francis has been guiding us along the way and making the right decisions. Good morning, Mr. Francis.
Good morning, Sharon. Nice to be here.
Yes, nice to have you back with us in studio once again for another show.
Thank you.
All right. So today, last week we dealt with credit cards.
Yes.
And now we are going to be dealing with insurance. And that's also a little bit of a tricky topic for some people as well. So for those of you who are wondering if you should get insurance or any tips you might want to pick up along the way because you already have insurance, this would be a program that you probably want to, listen in on. So we're going to get right into it. Now, Mr. Francis, many people shy away from insurance, like I said, because it's expensive, it's confusing, and even when you have it, nothing is actually guaranteed. I'm sorry, my phone is not on silent, clearly. Apologies for that. It is not on silent. All right, let's get back into it. Before we speak about savings, though, can you describe how insurance works?
Yes, well, it's all about coverage. And what we do with insurance is that we tend to prepare to protect yourself against the risk that something which can potentially happen and probably might happen, it does in fact happen, and because of that something, you are faced with a heavy bill to pay out. So when you buy insurance, what you're doing is you're paying the insurance company to take over and to cover your expenses in case you ever need to carry out those expenses because of something probable that could happen, but we're not sure it would happen, but if it does, you'll have to pay that bill. So neither you nor the insurance company knows that the thing will happen, and you will have to pay out the big money in the future. But chances are you may not have to pay it out, as well as chances are you just may have to pay it because that something has happened, and what the insurance company is doing is they are contracting with you to take over all your responsibilities and cover your expenses in full or in substantial part if that something happens. It's an agreement.
Okay. I think we got that one for those of us who don't actually have insurance. Okay. So many people actually consider insurance a waste of money. Especially if you never end up needing it. So what's your response to that?
This is getting on the border of what we were speaking about in previous programs about money attitudes. So to say that it is a waste of money and so on is really to adopt the thought pattern that you are paying, nothing is happening, therefore the insurance is not getting into expenses itself, it's only collecting your money, and therefore it's a waste of money. Some people even say it's a waste of time as well. But that is not so. That is not so because you did get your money's worth, even though nothing happened to cause the insurance to pay out. So let's try and take a simple example. Let's see if we could sort of simplify what is happening here. So let's suppose that you took out a policy to protect yourself against damage to your vehicle. Let's make it kind of specific, perhaps even ridiculous. Let's suppose you do an insurance against a tree falling on your car. So you take out a 1-year policy. If a tree falls on your car, then the insurance company will step in and pay the damage, compensate you for all damages done to the car. Well, 3 things could happen in a year. One thing that could happen is that a tree falls on your car. If a tree falls on your car and you've been paying your premium and your insurance is valid, then the insurance company steps in with the right paperwork and confirmations and so on, and they pay the substantial or all of the damages on your car, depending on what is the agreement. Now, a second thing could happen. That second thing could be that a tree falls on your car not only once, but twice, 3 times, 4 times in a year. Each time the tree falls on your car is damaged, the insurance company steps in and they cover each time, no question asked. Now, a third thing could happen. No tree falls on your car at all in the entire year, and your insurance is valid because you've been paying the premium. In that case, the insurance company don't pay anything. You have paid your premium, but what have you gotten? Now, suppose this is a case where there is only a 1% chance that a tree would fall on your car in the whole year, according to national statistics. You are actually paying for the company to take over that 1% risk. If it happens, they cover. If it doesn't happen, then they don't have to cover. But what you are getting your money's worth of here is that risk you have transferred it to the company, you can go and rest in peace. You can forget.
I don't know about the rest in peace part, but
well, I mean, you can have peace of mind because you know if something happens that you would not have to go into your pocket and to take out the money to cover the expenses to repair your car.
Right.
So that is what you are really paying for. So the question is that, have you really wasted your money? And the answer is you have not really wasted your money, because what you have done is that in that year, you have had a financial peace of mind and you have actually received the end of the bargain from the company. It's just that no tree fell on your car. So in that sense, that's what insurance is. It's a protection. It's to get your financial, it's to get your own peace of mind that in case the risk that something happens actually materializes, you suffer damages, then you won't suffer loss because the insurance company will step in and will replace what you have lost. So that is really what it is. Now that is where you get your benefit.
okay. But for some financial transactions like a mortgage or licensing your vehicle, you have to have insurance.
Yes.
And then there's health insurance and life insurance and all these other aspects of it. And honestly, having all of that can really add up. What should be covered with insurance, and how do you really know what insurance you need?
Right. Well, to start with, we remembering that the insurance premium is an expense. Insurance is not like savings or investment where your money is put there and it is growing. So it is correct to be worried and preoccupied about how much and to what extent you spend on insurance. So you want to make sure, having understood that you are buying the insurance to cover the financial risk that is very specific, but also that is substantial. So to start with, do not be thinking of insurance for small matters. So you should have an emergency fund, perhaps, that takes care of smaller things that may crop up. The risk of smaller things happening and you having to pay for them should not be covered with insurance, only the substantial things. So, for example, a dent on your car or you scratch your car on the gate, that's $600 to repair. Maybe you can cover that. You don't want to insure against that because the cost of insuring that perhaps might be even more, that level of damage might be even more over a year than actually paying for it yourself. If you have some jewelry, I mean, the cost of even an electronic earbud, that for $200, $300 goes bad. The cost of insuring that is too expensive. So you want to do substantial things. And that will be the first thing to determine what are the risks that you have that are, if they occur, they will have a significant impact on your life, the life of your family. So that's why you have things like your home, you would want to insure that, your vehicle, you would want to insure that, even your health. Medical bills can be substantial depending on your state and status in life, your status of health. Then you want to make your health insurance also significant. So that's the first thing that you really want to do. Ensure that you don't cover and sweat small stuff. You actually cover and sweat bigger stuff. And that's very important.
Okay, so don't take it for a smaller expense. Take it for a larger one. So these are the tips I'm picking up so far.
Yes.
And I would also probably say don't actually take whatever it is that the sales agents for the insurance is actually giving you. You have to kind of tailor it for yourself. So it's good to maybe ask a couple of questions. If they say, we want you for this, then they say, you have anything else? And then maybe make that decision.
That is one of the problems in our society, in our environment. We wait for the insurance agent to come, who is selling his product, his service, and she tells you that, this is good, that is good, and so on. Sometimes we even get to the point to just working out that we can afford to pay the insurance, and we just take it. We don't take care of what is called the fine print. We don't read the policy.
Or
We
hear,
don't-
hear it beforehand before then signing on, and then you realize, oh wow, okay.
That's correct. And that is one of the tips that is extremely important for persons. Whether you're just starting off in insurance or whether you have insurance already, it's important to check the details and know what is included in the policy, because what is included in the policy is what you're paying for. And so that looking at the details is important. A lot of us, we just wait there and whatever the agent says, we go along with it and we sign off on the dotted line. But we need to actually pay attention to it, because the cost of your insurance is always in the details of what is being covered.
Okay. Are there any general ways to save money on different types of insurance?
Right. So again, we know that the principal and types you're looking at are the house, the insurance, and so. And if we say a general, then one general way in which we would be thinking about is what we mentioned already, is to ensure that you work on those things that are essential, that are substantial. The other general way is to make sure you pay attention to the policy details. Now, another general way is to review your policy every year. A lot of people don't review the policy every year. All you do is you pay the renewal. Now, it's important to review the policy every year because things change. And with insurance policies, you are covering risk. So it could well be that your situation has changed during the last year.
And you didn't realize.
You didn't realize that you no longer have to pay the level of premium that you were paying last year. Or you might find that you may need to pay more because you have increased responsibility, or you bought new items for your house, and so your insurance cover for your internal appliances and so on damages, those now need to be those are now more, and so the cover need to be more. So it's important to review every year what your insurance policy is. Another important reason why you should review every year is because as a year go, the insurance company is actually providing new marketing tips and new marketing deals and so. And you may be locked in. Every year you renew afresh. So you may be locked into what you have, but it's only for a year. And when you're renewing, there may be certain deals, certain offers that are out there for new people that you could participate in, that you could benefit from. If you review your policy, then you are aware. If you don't review, you are not aware. So that's another important tip in a general way that can help you. Review annually your policy. And you can do so if you are not au fait with fine prints, and you can review it with the agent himself or herself. Just ask for help. You can have help from anyone who is able and capable of reading through and looking at what you have and be able to give you an advice or an opinion at the least as to what to do. So that's a general approach.
And I kind of like that as well, because now that we're almost into the hurricane season, you have that policy because you have a mortgage, you have that policy with the insurance, and yeah, it's probably good to look it over just to see if what you're paying for is actually what you're covered for.
Yes.
So that's a good idea for real. Okay, what about life insurance?
Mm-hmm.
You can make any savings there?
Right. Life insurance, one of the principal ways of checking, especially when you review it annually, is to look to see in the details what is there. A lot of the insurance companies, insurance policies will come in with some what is called riders. These are additional provisions in the policy that you pay a little more for. It sounds a little more when you start, but you put in an $11 here, a $5 there, a $20 there, and it becomes a larger premium. One example of a rider in life insurance is, for example, the accelerated death benefit, where in fact you can get out of the death benefit while you're alive if you have been diagnosed with a terminal illness. Now, some people pay for that, and that is in your policy. Perhaps you didn't understand too well, or perhaps you understood well and you paid for it. But if you analyze your own health situation, your life situation, you may determine that that's a rider you don't want to pay for. If you don't pay for it, your premium will be smaller for the same level of coverage, of life coverage. And you can think about it. It depends on specific situation. But if, for example, you have the opinion and you can review and you say, well, depending on the size of my family, depending on if my other family members are working or not, depending on my age, that rider, I don't need it, because if I'm diagnosed as terminally ill, true, I may need medical or so, but perhaps I have a health insurance under which that is already covered. Or perhaps I consider that if I really were to be diagnosed with a terminal illness, that I know already that in due course, before the time I would have liked to, I will be out. So I would prefer to leave that for my family. So I wouldn't be paying for that rider because I don't need it. So that's an example of a rider that you can do without in life, and that reduces your premium.
Okay. Are there any other add-ons in other insurance types?
Right. In other insurance, let me just give another possible saving on life insurance before I go to other. Take that because it comes to mind before I forget it.
No, sure, go ahead.
the waiver on premium. So there is also a rider where you get a premium waiver. So what that rider does is it says, if you cannot pay a premium for ABC reasons, usually it's about 2 or 3. One might be you fell ill. Another might be that you lost a limb or something and you can't continue to work. Another might be that you lost your job, things like that. Now, some of these reasons for waiver, each one carries an additional dollar on the premium. Well, I say dollar, but $10, $5 on the premium. You can lower your premium by determining, if I got something to do with illness, I already have a health insurance on my job. You can do like that. If you say, I might lose my job, well, if you have already done your savings or you have a healthy or relatively healthy emergency fund, you already have put aside some money in case you lost your job. You put aside your money for 3 months, equivalent of your salary or so. So don't put that in your insurance premium as well, in your insurance policy. You can avoid that one. So that's just another example of a life insurance add-on that what is called a rider that you really may not necessarily need to pay for. Now, other types of insurance, say like vehicle insurance, they are something similar to the rider. Those are like add-ons, right? So, for example, if you have more than one car in your home, right? Usually, if you had an accident or if you need to put your vehicle into the garage for any amount of time, then in your insurance policy, you can actually have an add-on that you pay for. So it's similar to a loss of use or so. But you can pay for that, which means that the insurance company will give you a car to use in the meantime or will pay for what you are spending. Now that is an add-on in vehicle insurance that you're not bound to pay for if, for example, you have more than one car in the family. Because that means you'll be able to use a second car. I mean, your sweetie or your wife will be able to take you to work, during the short period. So why pay an insurance additional money on your premium in order to cover that? Some persons, you have a brand new car in the warranty of a vehicle. Sometimes you have replacement whenever your car go into service even for a day. It includes that you will be given a replacement or a loaner, it's called. Mm-hmm. Now, if you belong to a car club, again, if you have a vehicle at home and so on, this is things that you don't have to pay for if your warranty covers it. Or if you have, or if you're in a country, like our beloved one here, then you know that it's not too far from here to there, and your regime of transportation needs is well known. Either you catch a bus, the bus service is okay, or someone will, you hitch a ride. You will do some pooling or so. When it's their turn, they will pool with you. So that's something you don't have to pay for inside your car insurance. So those are examples of ways in which you could save. Notice that saving is that you're paying less on premium for things that you really can improvise, otherwise not have to sacrifice, but still get the benefits of.
Okay. What about property insurance?
Property, yes.
That one is a little trickier, a whole lot trickier.
Yes, because property is a little more heavier, and it's certain, a lot of people, do not even insure the property because you consider that the house is there and so on. And a lot of people think that, we'll then cry out and, government might help and that sort of thing. Why save for insurance? But in property insurance, you are actually having good peace of mind. Again, we come back here with why you really take insurance. It's to cover the substantial loss. So what property insurance does is that it takes care of everything that Mother Nature could throw at you, flood, fire, hurricane, even those things that we call acts of God there in the policy, it's something that to be a real extreme for you not to really get covered. And so what you can have in savings and property insurance includes what you do with your property to ensure that it's safer. So in insurance, we transfer risk from ourselves to the company. So let's suppose one of the risks that you transfer is that people may break in, being thieves, bad man break in and vandalize or damage. So safety against theft and so on might be one. Now, if you had on your property since the last insurance, since you took out the insurance, an expense where you put on burglar bars, for example, right there, you tender that to the insurance when you review it on an annual basis or perhaps immediately, and you will receive a reduction in your insurance premium for your property. So that's one way. Depending on how you strengthen the security in your property. In the insurance policy itself, you'll see, and you can ask the agent or the company, which type of measures I can take in my property to reduce the premium, and they will tell you. So, for example, if you are installing security cameras, which is becoming very popular now, just by having security cameras on your property, you can reduce the premium. Why? Because that risk is lowered because you have increased the level of security in your property. Again, if your house was built a long time or if it was built recently and you didn't have hurricane shutters, just by putting in hurricane shutters, even what you could install for yourself, you then tender that I now have hurricane shutters on my house. That reduces the risk that your windows will be damaged. It reduces the risk that water will soak and destroy carpets and so on. And so you can pay lower premium because you have installed these things. So those are measures you can take, physical measures on your property to enable that a lower premium. And it's a savings in that sense because you're covering the same amount. It is the same amount of coverage, but the premium is less because the risk has been lowered. You have now taken on and you are transferring less, taking on some and transferring less to the company. So you have property insurance savings that can be had as well, similar to the others.
Well, I'm going to look that up on my on my insurance forms. Let me tell you, going to look that one up. All right. So there are times though when you make a claim, something happens, and you make a claim, and you don't get what you thought you were going to get. Why is that?
That you're referring to the deductibles?
Well, yes, that's the word I think that does come up for real.
Yes, deductibles. Now this could be quite annoying because you actually go down the months and you pay in, for your
diligently.
Yes. And then you submit a claim, you expect X dollars and you get something back, and usually you get it back in a very impersonal way, a letter with a check, and it comes in a mail and it says that you get it X%, and then you also have to look at the back and look at the details and read all this thing, and what is happening is that you get in less than you put in. So in some other countries, it's more famously called copay. So it means a portion that you are paying as on the same claim, and the insurance is paying the other part. So the deductibles, they are a reality of insurance policies, and so very famous, very popular. You experience it a lot when you submit health claims. You have spent $800 and you expect to get back $800. Or at worst, you might get back $740, but then you get back $400. What is this? Now, when you are negotiating or taking out your insurance policy, one of the things you have to consider is whether you will have a higher or a lower deductible. The way it works is that the higher your deductible, the more of the amount that you are assuming to pay for yourself when you submit a claim, is the less your premium on a monthly basis would be. And that's because the insurance will be obligated to pay a smaller amount of any claim. So you have that inverse relationship. You have that opposite relationship. You can pay higher premium and your deductible is lower, or you can pay lower monthly, lower premium, and your deductible would be higher. So that is what you have to consider when you negotiate. And now, again, it comes like this. If you have a decent emergency fund, than you could afford. If your financial or your money management, your money handling, has been taken in some of the tips we have here on Money Matters, it means that you now have an emergency fund. And one of the things you can do in taking out your insurance is to know, well, at least I'm sufficiently capable, financially capable of handling up to $1,000. I will make my deductible to $1,000. Now, in vehicle insurance, for example, I actually had a review which said, let me see if I can find it here, that you can indeed reduce your premium by as much as 30% if you are reduce your premium by 30% if you are increasing your deductible from $500 to $1,000. That is a lot, isn't it?
I was just gonna say, I don't know if I could even do that in the first place.
It would be very difficult, but again, that's how it is. It is done in such a way when it's calculated, because all risk and coverage is in such a way that you actually it makes more sense that you pay the insurance company the higher premium for them. And for you, if you will not be able to pay the deductible, but if you're able to handle deductibles up to that amount, then it makes sense to reduce and so on. So that's what the deductible is about.
Okay, all right. Any other tips that you can possibly share that you haven't mentioned before?
Yeah, well, coming to mind again, insurance is a thing you can speak for quite some time, and you could have spoken on car insurance alone for quite the entire...
about an hour or so, I'm sure.
Yes, some things that there, small tips, very quickly. For example, in car insurance, now, because they're talking about the risk, one of the ways in which you can save on the level of premium that you pay is to add a second driver on your policy. Now, it should be a second driver. I don't mean like if you have another driver, you put the other driver and it's your car. That, I think, is illegal. So, but you can add a second driver, especially if the second driver has a better driving record than you. Because when you go to take out a car insurance, they look at your driving record, they look and see what has been your history, any accidents, any claim or so. So you have a better driving record than someone else. This may not work. But if you have someone like your spouse, your relative, and they have a better driving record than you, one of the ways in which you could reduce premium, and that's because the average risk that is in there calculated is lower when you add on that other person. That's an example of how you can save as well. And that is on vehicle insurance. Another way in which you can save is when you put together multiple vehicles under the same insurance. Even people don't know that home and personal insurance can get that benefit just like vehicle and fleet insurances. So you put them together and it's the same company, and they prefer that you have both of them together than to have them in different companies, and therefore that's another way in which you can possibly save as well. And so you have these ways. In these times, when things are so tough for the economy and so on, and you want to reduce, another way in which you can save is to see if there is opportunity for you to bundle where you take your insurances from. So instead of having house insurance one place, life insurance another place, vehicle insurance a third place, you can look for the opportunity. And right here, there are opportunities at this time. From my review for this program, there are opportunities where you can pay cheaper. So if you were paying $200, $150, $150, just by bringing them together under one roof. And remember, with these insurance, you renew every year, so you're not really wedded to that for life. Mm-hmm. So the next year, if it is better, when you do your annual review, you can separate them if you like. But in this year, this post-COVID, this COVIDous time, as we call it, when everything is increasing, that's another way in which you can seek to improve on your spending. One very important thing in all of this that we've mentioned, if ever you spend less on insurance, because insurance is an essential, as we said, is a necessary, whatever you save in, the good money management trick, the good money management habit will then bring you to taking that money, not on spending it otherwise, but on adding it to your savings or making it available for your investments. And that is the essential reason why you want to go to the trouble of saving on insurance, so that in saving, not having to pay, you're actually increasing your wealth building capabilities by having this money now available and not just going and throw it away. It doesn't open room for you to spend luxuriously otherwise. It opens room for you to save for tomorrow and to build your wealth through investments.
All right. And my takeaway is to ask questions if you don't know.
Yes.
ask questions of your agents if you are, looking into getting some insurance.
Get
Because
help.
again, we are, approaching the hurricane season, and they said that it's like a 60% probability that we might be impacted in the Caribbean.
Yes.
So that's definitely one thing to, look
Yeah.
into.
And I noticed you mentioned the hurricane season several times. Now, the truth of the matter is that even though what you insure is not the full value of your property, at this stage, we again are trying to assist. It's a public awareness program. So we say to you, go try to insure just a portion. Even if you can't insure the whole one at this stage, start building the habit, start building the experience and the knowledge that you can now handle insuring your property. So if your house is worth, I don't know, $800,000, and you could only afford to insure based on the premium that your agent might tell you, $100,000, do that. That is better
Than nothing at all.
Correct.
That's a great tip. I did not know that you could do that.
You can.
See, that's why you listen to the program with Mr. Francis. You get great tips.
You can.
Well, thank you so much, Mr. Francis, for coming in again and enlightening us, and myself included. We will look forward to seeing you. What are we discussing next week?
Right. I was thinking of discussing car insurance. We have a few questions we got on the credit cards. So we will spend some time on doing questions at some program. But I was thinking of doing, not car insurance, sorry, saving money on purchasing vehicles.
Oh, okay.
How to fit that into your budget planning, the 50-20-30, the 50-30-20, or the 70-10-10 and 10 rule, and so on. How to fit purchasing cars and saving on purchasing vehicles.
All right. Well, thank you so much for coming in. We look forward to our next program right here on WINN FM next Wednesday at 10:15 a.m. Have a good one, Mr. Francis.
Thank you so very much, and pleasant day to you, pleasant day to everyone.